All right, welcome back to another episode of the Black Bullion Show. Has silver been crushed into an oblivion? Simply no. Why? Because this market upswing that we're seeing in equities will be short lived. Now, if you guys are new to this channel, I'm Black Bullion. Welcome. Please subscribe to the channel if you're new. Please like the video to help get this economic evangelism out there. And if you would like to see or read a short description of this video, if you don't have time for it, check it out in the description below this video. Okay, so let's get into it. Why will this upswing be short-lived? Because we are in a classic dead cat bounce. Now, check out this article title from Lobo Tigre on Kitco News. Silver, rumors of my death have been greatly exaggerated, and I couldn't agree more. Now, here is why. Here's some data from Bloomberg. And this is a brief history of S&P 500 bear market rallies, also known as dead cat bounces, and what follows afterwards. Now, this is written by Sam Potter and Eddie Vanderwalt. And Eddie Vanderwalt is amazing. Follow him on Twitter. He's fantastic. So let's take a look at what these guys were able to parse out. I'm just going to read this brief bit of information here. So just how common is a bear market rally and what happens afterward? It's a question loaded with difficulties because even defining bear and bull markets is an area of fierce debate. Since the end of 1927, the index that ultimately became the S&P 500 has experienced 14 separate bear runs, according to Bloomberg calculations that define them as beginning any time the gauge closes more than 20% below the record peak. Assuming a bear market continues until the index either doubles from a post-peak low or climbs above its pre-bear high, the average duration was 641 days. That's 641 days of a bear market. Within those periods, America's benchmark equity index has rallied more than 15% on 20 separate occasions before retracements. This is the phenomenon of the dead cat bounce. These advances last about 78 days each, but even some retracements were littered with upswings, underscoring how hard it is to define a trend when sentiment is febrile. Now, take a look at some of these advancements. This one was 2 days, 18.2%. This one was 148 days, 46.8%. This one was 72 days, 25.8%. But on average, they're saying that it generally lasts about 78 days. So I'm going to be looking at my phone at the S&P 500 since the lows in March. So the lows were around March 23rd. And right now we're at May 8th. This is recorded on Friday. So what that tells me is that roughly around, let's say early to mid-June, we may see a dip in the S&P 500 if it follows the average bear market rallies or dead cat bounces, whatever you like to call it, that history has shown. Though it could possibly extend into the summer, remember, some of these lasted for 148 days. So some of them can last a little bit longer. But this dead cat bounce, it won't last forever, according to history. And eventually, silver will catch steam after lagging behind gold. So, do you think we're in a dead cat bounce? Let me know in the comment section below. Thank you for watching this video. Please give it a like. Please subscribe if you are new. It's Black Bullion.